I want to bring in the chart expert, Frank Cappelleri. He's the founder and president of CappThesis. Frank, we've been talking so much about fundamentals, the economy, earnings, factors like that have been driving the market as stocks sit near record highs. But I know you've got the know-how when it comes to patterns and charts. What are the charts telling you about the S&P 500 right now?
First of all, Kristen, thanks so much for having me. Great to be here at the New York Stock Exchange. And so for the S&P 500, I think we should take a look at the big picture first. So the big picture is that we had a big breakout in January, and at the time, it triggered an upside target of 6,100. Now that's looking at a pattern that had to form over the last year and a half or so, and the breakout zone was 4,800. Now the thing with pattern breakouts is that they're always tentative until proven otherwise. So we didn't know if this one was going to work out, but as we know, from that point, the market extended higher. That gave the S&P 500 the ability to back and fill when it needed to. As we know, that had occurred a number of times since that point, in April, and again, of course, over the summertime. So along the way, we want to look for just smaller patterns to develop. And from the October low of last year, by our count, there have been 9 different successful bullish patterns, meaning that we have the pattern form, we have a clean breakout, meaning that the pullback does not negate that breakout zone and an upside target gets hit. That is the crux of how uptrends are formed. And so right now, of course, we get to the point where we're in October, and if you look at the entirety of the move from 2 years ago, October 2022, the S&P's really been within this upper sloping channel, and it oscillates between extremes. When the biggest drawdowns have occurred when the stock or the stock index is near the upper line. So it's near the upper line now. It's not every time do we have a pullback, but the biggest ones have come after we extended up there. So what can happen at this point, I don't expect the market to really take off and go through that line. If it does, that means we're in a very exuberant phase. But I think more consolidation around this point will kind of bring it off of that extreme. And of course, the other part of it is if it needs to pull back much more than that. And again, we can talk about the factors related to that as well.
Let's talk about those factors. We had seen, as I mentioned, the S&P 500 down the first 3 days of this week, but came after 6 straight weeks of gains for that index and the Dow, and the best weekly winning streak that we had seen all year. What are some factors that could potentially turn this consolidation into a deeper pullback?
Well, one of the things to look at is volatility. Now, we can talk about the VIX, but another way I like to look at it is looking at the number of 1% moves the S&P 500 has on a rolling monthly basis. Because the thing about the VIX, one is to go up when the market goes down, but it really fails to capture upside volatility. And that's important as well, because when there's volatility, it's two ways. We can go back to 2022 and see that year we had nearly 130 absolute 1% moves and just about equal amount of 1% declines and gains. So right now, that's been a different story. It's been much lower. The only time we had more than 8 in a month was August. There was 10. And remember, that started with 3 straight declines, or much more than 1%, and then 7 1% gains followed it. So to me, that's back and forth movement, and that is a lot of two-way volatility. So the best case scenario, of course, is that you get a market where it just continues to go out little by little like we saw in the fall, or I'm sorry, in the beginning stages of this. So what could cause a bigger pullback at this point? When a breakout fails. So we have 2 different targets in the market right now from a lower point, but we just had a breakout of 5650 for the S&P 500. If that gets undercut, that would show to me that the behavior potentially has changed, and we'll have to see if there's no bearish pattern start to form.
People might be wondering, our viewers, are the charts truly indicative? Can they truly provide signals as to where stocks are heading? What would you tell them?
Probably going to give you a biased answer at this point. Well, my first boss, Alan Shaw, had a great quote: "In price, there's knowledge." Because sometimes we don't know what is driving anything, but if you see a stock or a sector outperforming for some reason, eventually a story comes through. You may not understand it, and that's why a lot of times people can have the best thesis that eventually could play out. But in the meantime, the stock can go back and forth or maybe outperform for a much longer time than we expect, and we have to respect those trends. So some people like to use fundamentals to get the ideas and to help trade it, or timing-wise, technical. So they both can work.
I want to talk more about the yield because there have been conversations as the yield rises that we might see fewer rate cuts by the Fed, a level of 4.2. What does that mean from a chart perspective?
Yeah, 4.2 is extremely important. Anyone can see that on the chart going back to the last 2 years, because now we're right back up to it. right? And so that's been a level that's not only been resistance, but support as well. And you can use technicals the same way on rates as we do stocks. And for right now, for me, that's just a line in the sand because it's taken a long time to get back up there. Now, the other part of it is how fast this has happened, right? It's happened, as we know, right after the Fed cut rates for the most part. People are wondering why. So the question is a move like this indicative of a much bigger advance in yields, or is it just a reflexive move for whatever reason? So I think what we have to look at, sometimes you can put technical indicators on this as well, and from that perspective, the 10-year yield is overbought, right? And so if you look back at what's happened to overbought conditions in the yield over the last year, the yield has been coming down over the next few weeks after that. Now, that's important to realize, but also what happened before this. Now, we remember 2022, one of the biggest rate hikes in history, and the yield was moving up in an accelerated clip. And so during that time frame, there were a number of months when that overbought reading routinely happens. So what we don't want to see, of course, is that be the case, where I do expect the yield to come in, just a matter of what's the next move there? Is it going to continue to produce overbought readings? If that is the case, that shows that investors are expecting more inflation, and you're going to be reflective in yield. And I think the Fed would have to pay attention to that.
I want to talk about the small caps because even as we've seen, this bull market recently turned to the S&P 500 up about 60% in the past 2 years since that October 2022 low. Small caps have struggled to keep up. We saw a little bit of a recovery over the summer. What is the Russell 2000 chart telling you right now?
I think it wants to break out long term. Now, let's remember too, it's really done pretty well from the October 2023 low. So about 40% from that point, just about what the S&P 500 is doing, has done it in pockets, as we know. And so if you look at the chart there, we know it's up that much. For it to get back up to its former high, it would have to be up 50%. That's a huge move. But if you look back to the last number of years, it's done something very similar. It's taken its time, it's come off a high, taking sometimes years to come back to it, with very strong moves to that point, and then seeing extremely strong percentage moves over the months and years that follow. So I wouldn't be surprised to see that again. The question is it going to outperform the S&P once it gets to there? Because if you put a relative line of, say, the IWM, Russell 2000 ETF, versus the S&P 500, every time that the Russell has broken out on an absolute basis, it continued to move lower versus the S&P 500. So I think we really need to see a lot more from the Russell on a continuous basis to believe that long-term trend of underperformance versus the S&P is going to change.
Frank Cappelleri, founder and president of CappThesis. Frank, so good to get your take as someone who has studied the charts for as long as you have. We really appreciate it.
Thanks, Kristen.